U.S. banks are profiting on the war and making big money. I'm your host, Steven Van Metre, and thanks for joining me today. And the big banks are raking in tons of money on the war in a topic that some of you will say, well, that's just good old American capitalism, while others will be completely disgusted. And on top of that, we're seeing signs that inflation is really impacting the middle class. Let's over to CNN, where we pick up the story that banks are making big money off of Russian debt. U.S. banks have left Russia, but that doesn't mean they're done making money off the Kremlin's horrific invasion of Ukraine. The sell-off of Russian debt associated with Russian President Vladimir Putin's campaign on Ukraine and the sanctions that have ensued have created a window for a new type of arbitrage that some of the finance world are gobbling up and seeing as easy money. The idea of what's known as a negative basis trade, or purchasing dirt cheap Russian government or corporate bonds along with credit default swaps, which act as insurance on the potential default of a borrower. Normally, this type of trade doesn't make sense, but as institutional investors looked to quickly rid their portfolios of anything Russia-related, bond prices fell faster than the price to hedge them rose. And that, for a bank, is an arbitrage opportunity. So what they noticed as price was falling faster, they were able to grab it at the lower price, and they're going to turn around and flip it at a profit. Russian bonds are trading furiously, according to Philip Nichols, an expert on Russian social responsibility and business and a professor at the University of Pennsylvania's Wharton School. There's a lot of speculators that are buying up these bonds that have been severely downgraded and are on the verge of becoming junk. Nichols said he's getting constant calls from analysts interested in whether the potential trade makes sense. He says the spread on Russian sovereign debt is astonishing right now. They're making an unusual amount of money with respect to the volume. And U.S. financial institutions like JP Morgan Chase and Goldman Sachs are facilitating these trades, connecting clients who want out of their positions with hedge funds that have a higher risk tolerance and less of a moral quandary about purchasing Russian debt. And so what you're getting to see here is the big banks are literally just acting as middlemen, buying at a lower price from someone who wants out and selling them at a higher price to someone who wants it, someone who doesn't have, as the article says, a whole lot of standards with what they buy. JP Morgan representatives say they're acting as a middleman, simply looking to aid clients. As a market maker, we have been helping clients reduce their risks and manage their exposures to Russia in secondary markets. None of the trades violate sanctions or benefit Russia. If clients wanted to quickly unload their exposure to Russia, they could look to Russian oligarchs who would happily buy back sovereign bonds, according to Robert Tripp, the chief investment strategist and head of global bonds at PGI and Fixed Income. Selling Russian debt to U.S. hedge funds keeps any accrued interest out of Russian hands. The trades are legal and lucrative, he says, but highly speculative and subject to large swings on the news of Russia's invasion and Ukraine and further sanctions. And so now you get a glimpse that banks are absolutely willing to make this trade and cash in big. It also illustrates an alarming disconnect between Wall Street and the actual state of the global economy. Typically, investors would base their valuation of Russian debt on whether or not it will be repaid, and the likelihood that it would be repaid would depend on the strength and durability of the Russian economy. But that's not happening now. New sanctions by the U.S. Treasury on Tuesday, which blocked Russian access to any dollars they held in American banks, significantly increased the chances that Russia would default on its debt and that its gross domestic product, the main measure of the country's economic strength, would tumble. And so, again, all you're seeing is the banks taking advantage of people who must sell and must sell now and are willing to take any price. And so they will accept a much lower price, and they're flipping them at a higher price to eager buyers rather than connecting them together. And perhaps you'll say, again, that's just good old American business. Some of you will be very disappointed that the big banks are participating in that arbitrage scenario. But when we look at what's going on outside Russia, we see in the U.S. banks further problems stemming from Americans who are saddled now in even more debt as inflation takes off. Let's head over to Zero Hedge, who headlines shocking consumer credit numbers. Credit card debt soars with savings long gone. And here are the shocking numbers. In November, consumer credit exploded by a whopping $41.8 billion, more than double the expected $18.1 billion print, nearly 5 times more than the upward revised $8.9 billion January number, and the highest on record. And now we're seeing consumer credit blow out. And what's likely to come next when you see a blowout on consumer credit, as I'll show you in a moment, well, that is an indication of a recession. But there's one thing that doesn't have to end a recession: with the economy, and that's your portfolio. Be sure to check out Portfolio Shield. I'll put a link up there in the corner and in the description below. So let's continue on with the story, because the real stunner was revolving or credit card debt. Now, this is something that I've talked about, and I want you to understand what's really going on here. It soared nearly sixfold in February to $18 billion from $3.1 billion. So that's a huge jump in January, the second highest print on record, just in time, as the article says, credit card APR starting to move higher as the market demands higher interest rates. And why are we seeing this? Because when consumers can't afford inflation because it moves up faster than their pay, they will finance it under the belief that their pay will eventually catch up to it. And so they will be willing to use their credit cards. The problem happens is when prices continue to rise and their wages don't, and now they've got extra debt on top of higher prices. And here you can see total revolving credit, second highest on record, blowing out big, huge numbers. Again, a lot of this is inflation driven. And while this unprecedented rush to buy everything on credit at a time when there was no notable hallmark holiday should not come as much of a surprise. After all, we have repeatedly shown that for the middle class, any excess savings are now gone, long gone. And now what you hear when you refer to this excess savings, as always, these articles are referring to all the money received from the pandemic, all that fiscal stimulus. Some of it did get saved. About a third of it got saved. And so the notion is that households have tons of cash sitting around and they can buy stocks or afford higher prices or weather any storms. And what we're starting to see in the data is, well, they don't. But let's dig deeper into this so you understand when you see this in articles in the future, what it means. And they're referring to the personal savings rate, and the personal savings as a percentage of disposable personal income. So that's disposal, meaning excess income that you don't need for specific bills. Frequently referred to as the personal savings rate is calculated as a ratio of personal savings to disposable personal income. Personal savings is equal to personal income less personal outlays and personal taxes. It may be generally be viewed as a portion of personal income that is used to either provide funds to capital markets or to invest in real assets such as residences. So you kind of get an idea here is this is some excess money, and it usually gets saved to be an investment vehicle. It doesn't imply that it always goes into stocks or it goes into real estate, but that's the idea of what we're going to look at this data point now. And let's go over the charts. And what you see here is a personal savings rate is down to 6.3%. Now, this is not a good timing indicator. And you can note that going into recessions, we tend to see periods where it declines. You can see that here in the late 60s. You can see it going into the 1980 recession. And it fell after the 1980 recession, but didn't trigger one. So the 1991 had nothing to do with that. You can see it dip going into the dot-com bubble, and it was fairly low. But for many years for 3 years, going into the great financial crisis. And so does it actually mean that consumers are going to turn their back on the equity market? It just means that inflation is really starting to have an impact on households. And let me show you, when we overlay the consumer price index on a year-over-year rate of change with the personal savings rate in blue, and you'll notice that when you see consumer prices rise, what happens to the personal savings rate? It declines. Consumer prices rise, savings rate declines. Here you can see it was flattened out. So it really didn't have that much of an impact here in the late 80s, but it had an impact going into the dot-com bubble, and it dropped it down, and you see the great financial crisis, and now you're seeing it have an impact again. And absolutely, that does make a difference of people's ability to invest. And that may be one of the reasons we're not seeing the stock market make new all-time highs, but slowly go down, because there just isn't enough money to keep it going. But with earnings season coming soon, we're going to find out that even corporations are going to cut back on their buyback binge as their debt is rising too. And of course, now you understand why consumers have an even bigger problem. Not only are their wages not keeping up with inflation, but prices are still rallying on consumer goods, and their debt payments are going up. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.